Hi everyone, welcome to today's session. Now, few relationships carry as much weight as that of China and the United States. In this special edition webinar, we will have the opportunity to uncover the complex US-China relationship and its implications for investors. The session will cover important issues in the US-China relationship, including US elections, geopolitics, trade war, and the future of the Chinese economy. And then we will wrap up the session with a round of Q&A. We will kickstart today's session with a short introduction to our esteemed speaker, Mr. David Adelman, former US Ambassador to Singapore. David is a Managing Director and General Counsel at KraneShares. He previously was an MD at Goldman Sachs in Hong Kong and partner in two global law firms in New York, Washington, and Atlanta. David was the 15th US Ambassador to Singapore, serving during the first term of the Obama-Biden administration. He previously was also an appointed member of the Monetary Authority of Singapore's Capital Markets Committee and served on the executive board of the Hong Kong Treasury Markets Association. As for myself, I'm Ritesh and I head up investment and advisory at Syfe. I'm responsible for the overall development and evolution of Syfe's investment product suite across the region. Introducing Syfe. Syfe is a digital investment platform with a mission to transform the way people manage and invest their money. We believe in providing the best tools and resources so that people can improve their financial position and attain better outcomes in life. Now, a little bit about Syfe and KraneShares. KraneShares and Syfe, we hold a very special relationship that combines KraneShares' deep expertise in the Chinese market and Syfe being the gateway for investors looking to deploy their capital in Asia and beyond. We have been working together for a few years, and last year we formalized our partnership with the launch of the China Growth Portfolio, focusing on the new economy sectors of China that will drive the next phase of growth for the Chinese economy. After a tough few years of the Chinese equity markets, we've seen positive momentum building up this year with our China Growth Portfolio up 10% just in the month of February. We're very excited to see how the Chinese economy continues to trend forward. David, thank you again for being here today. Now, the United States and China have one of the world's most important and complex relationships. And despite apparent economic tensions between the two countries, recent diplomatic efforts signify an ongoing commitment to keep the communication channels open. With that backdrop, let me hand it over to you to share your views on navigating the future of the US-China relationship and its implications for investors.
Good. Well, thank you, Ritesh, and thank you to Syfe, your entire team at Syfe, and thank you to all the people who have logged in to participate in this webinar today. I would be remiss if I didn't thank you for your very strong leadership of Syfe. We're very excited at KraneShares to have this partnership to make our China thematic funds available to more people, especially in the markets you have recently entered and your home market here in Singapore. You're exactly right. The US-China relationship is the most important bilateral relationship in the world. It's important to China, it's important to the United States, and it's important to, in fact, all the people of the world. And this is the very basis of our business. We believe that the most important story in the 21st century is the story of the rise of China. That's the investment thesis, the business case, if you will, that John Crane brought to the market when he founded our firm beginning in 2013. And we're very proud to have in our 13 New York Stock Exchange listed ETFs, the largest China Internet Fund, our flagship fund, KWEB, which now has more than $5 billion in assets under management, more than 200 million outstanding shares. Today I want to talk about the US-China relationship and make it a little bit of a macro discussion, just to I suppose begin with setting the scene, and then we can take it forward and talk about what the recent developments in the relationship should mean to investors who are looking to either increase their allocation to China or are looking to re-enter in many cases to begin again with China exposure. So let's start with some of the big issues. If you and I, Ritesh, were having this conversation even only 18 months ago, we would probably be talking about the potential of delisting Chinese companies from the U.S. exchanges. We most certainly would be talking about the prospects of potential COVID-related lockdowns and maybe a return to the very extreme policies of the Chinese government. We're no longer, of course, talking about those issues. And if we were to go back maybe 2 or 2.5 years ago, we might even be talking about China's policies with regard to the internet, so-called internet crackdown laws. I'm happy to report that over the last 18 months or so, we at KraneShares believe all of those issues have really cleared out. The risk associated with any of those three are minimal, or in fact, I'll venture to say zero. There are, however, a couple of issues that are worthy of a close look, and that's what I want to talk about today. First, there's of course the real estate issue, and China having to work through its real estate problems. We believe the strong government policy of using public money and managing Chinese consumers through some of the overhang associated with the real estate crisis in China is well underway, and we know that China is committed to resolving those issues. And then there's the geopolitical risk, which is, I think, front of mind for many investors, especially those who live here in the Asia-Pacific region and sort of see it on the front page of their newspapers every day. The geopolitical risk is the area that I spend most of my time on. My team and myself, we devote ourselves to staying on top of all of the dialogue and everything that's been happening between the United States and China. And I'm happy to report the news is good, or maybe I'll say the trajectory is good. These are the two largest, most powerful countries in the world, and will be for, as I've said, at least the next century. So without a doubt, there are going to be speed humps and rapids that must be navigated along the way. But for sure, it's in the interest of both countries for the relationship to be positive and stable. And let me stop there and speak in terms of this relationship and this issue of stability from the perspective of China. I'm often asked a question, if you could get inside President Xi's mind, what would we find? And I'll tell you my theory. While I'm not a mind reader, to me, it seems clear that when President Xi wakes up every morning, he wants a stable day. All of their policies, all of their management, all of their messages to their people and to the world are in the interest of promoting stability. He has a very, very hard job to do. 1.3 million people, 800 million of whom have only relatively recently fought their way into the middle class, and each and every citizen of the People's Republic of China seeks upward mobility. And in order for the Chinese Communist Party and President Xi to manage that, he, before any other issue, must promote stability in China. Now, with regard to the United States, the U.S. position as it relates to China has evolved. When I was in the government, in the Obama administration, we promoted the so-called pivot to Asia and prioritized an engagement with China. The idea that was forwarded by my former boss, Secretary of State Clinton, and President Obama was to engage on all fronts with China on the belief that our increased engagement would bring China closer and would help us manage to a place of true cooperation or collaboration. Now, of course, that evolved over time. And it's not important sort of what the causes of that were, but there was certainly some erosion of the trust between the United States and China. And by the end of the Obama administration, we entered a more cautious time in both Beijing and Washington, where increasingly we were moving towards a competition, which ultimately, I think, on both sides of the Pacific was intended to ultimately lead to cooperation or collaboration. Now, what happened with the very fateful election of Donald Trump is that cooperation or competition, as President Obama put it, quickly moved to a confrontation. Donald Trump believed that the best way to manage the U.S.-China relationship would be to confront China, and that confrontation would ultimately lead to cooperation or collaboration. And as a result, we had 4 years of very intense economic policies that were designed to not just have the United States run faster than China in the competition, but actually to try to slow down China. Most prominently, this took the form of 25% across the board tariffs on all goods imported to the United States from China. And of course, that led to a drag on the American economy and contributed to, I would say, wasn't necessarily the sole cause of, but contributed to the inflation that American consumers faced. Of course, Trump was defeated and became a one-term president, and that conflict or that confrontation-based policy was handed over to the Biden administration. A lot of my friends and former colleagues in the government got promotions and are now leading the U.S. government foreign policy, especially globally, and as it relates to China. People like Jake Sullivan and Anthony Blinken and Kurt Campbell all served with me during the time when we were promoting engagement. Well, 8 years later, they came out after the second term of Obama and the one term of Trump, and they were a little more hawkish towards China. They didn't go directly back to this policy of engagement, and they built American foreign policy as it relates to China around this idea of a strategic competition, that it would be a fair competition in one global economy, and that competition would ultimately, that fair competition would ultimately lead to this collaboration or cooperation between the United States and China. And I would suggest to you that that policy thus far has been fairly effective. It certainly is reflected in the strength of the U.S. economy, and I think it is increasingly reflected in the momentum that the Chinese economy seems to be building once China is able to satisfactorily resolve the real estate related, the property related issues. And there are some good milestones for investors to look to. In my business, as a diplomat and businessman, I try to focus on the amount of communication there is between Washington and Beijing, and that has markedly increased over the last 6 months or 1 year. John Crane, our CEO, and I were lucky enough to be involved with President Xi's dinner in November in San Francisco on the margins of the APEC summit. We also attended the Biden event that same week. It was a very interesting contrast in the style of the event. President Xi did a Chamber of Commerce type of speech where he addressed American business leaders. President Biden had a fun cocktail party and performances by Gwen Stefani and other American singers. But nonetheless, the message that they were sending to each other was the same. And that is, it's important to put a floor under the U.S.-China relationship, that the rising tide should ultimately lift boats on both sides of the Pacific. And they came to agreement on 3 very important issues. For President Biden, it was a priority to have China work with the United States to try to eliminate the flow of precursors to fentanyl to the United States. America is suffering from a fentanyl-related crisis, and President Xi immediately agreed, and in fact, by all accounts, the execution on that agreement has been stellar. Washington is very happy with the way Beijing has worked collaboratively with the United States to cut off the flow of fentanyl to the United States. The second agreement was one that was very important to President Xi. President Xi is discouraged that the number of U.S. students studying in China has dwindled to almost zero. In fact, it is less than 1,000 American students studying in China. He believed that building that floor under the U.S.-China relationship required a more free flow of student and scholarly exchanges. And in fact, President Biden committed to put the United States government effort into promoting those exchanges, and that is well underway. It takes a little bit of time to build up the pipeline of students going to study in China. But by, again, all accounts, the United States is putting its full effort into making sure that the numbers are boosted again, hopefully closing in on the pre-COVID levels. President Xi identified 50,000 U.S. students over 5 years. And as I've said, my sources tell me the United States will help China meet that number and in fact exceed that 5-year target number. Now, the third agreement perhaps is the most important one, even though it received the least amount of attention. And that is that both leaders had as a priority an increase in military-to-military communication at the highest level. And this is something that people in my community in diplomacy and security found to be especially important. And in fact, the execution on that has, again, been terrific. In January of this year, for the first time since COVID, high-level Chinese military officials met in person at the Pentagon. Why is that important? It's important because most people in the diplomatic and security community do not think the United States and China are going to go to war, but are very careful to note that there's the potential for an accident or a misunderstanding. There's a lot of military hardware that is in the region, almost, just off the coast of Singapore in the South China Sea, and there's always the potential for some mishap, some miscommunication that could escalate into something much more dangerous. And history tells us the way to prevent that type of mistake is to promote and maintain robust military-to-military communications at all levels. And I'm very happy here to tell you and to tell the Syfe community that that is very much underway. And people on both sides of the Pacific, in the MINDEF in Beijing and in the Pentagon in the United States, are sleeping better every night as a result. I know we'll talk a little bit more about the state of the relationship when we get to the question and answer sessions. Now, of course, this year is a political year in the United States, and we undoubtedly are headed for a rematch. It's going to be, for the first time since 1912, two former presidents running against each other. Excuse me, I misspoke, Ritesh. 1812. Wow. And then it was in 1892 when there was immediately after the Civil War a rematch of two candidates, not two former presidents. So this year in the United States is kind of a once every century event where we have candidates with these types of histories running against each other. What does it mean for U.S.-China relations? As I mentioned, President Biden, when he was the vice president, was part of this team that promoted this engagement to lead to cooperation. Of course, President Trump led the confrontational foreign policy towards China. So what does that mean with regard to the outcome? Let me say first, I'm not going to predict the outcome of the U.S. presidential elections, other than to say it'll be very close. We can expect that. There's not going to be some sort of landslide that happens on November 6th of this year in the United States. And I would caution investors to not pay any attention to the national polls. As a reminder, we have an electoral college system. So in a sense, it's 50 separate elections. It's not one big national election. As a matter of fact, I think it's safe to predict that President Biden will win the popular vote. He will win the popular vote by many millions of votes. Nonetheless, this is going to be a very close election because we have 6 or maybe 7 states that will be decisive. In the southwestern United States, Arizona and Nevada will be close states. In the southeastern United States, Georgia and potentially North Carolina will be close states. And then, of course, there's the 3 states in the Midwest that I think the world has become very familiar with. Pennsylvania, Wisconsin, and Michigan will be close states. And I think a president will be elected based on the outcome of those 3 statewide elections. And as a reminder, 4 years ago, in each of those states, the margins were razor thin. And I think we can expect the margins to be razor thin again. Now, what does that mean? We at KraneShares, of course, need to understand the impact on the Chinese economy and the U.S.-China relationship, regardless of the winner. And we have concluded, when looking at the history, because we now have 4 years of each of these candidates, that in many ways, U.S.-China relationship will be stable and the trajectory will continue in a constructive way, regardless of the outcome. Because in fact, despite the different styles and the different tones of the rhetoric, with Trump being confrontational and Biden being more conciliatory, the fact is the policies were very similar. When Joe Biden entered the Oval Office, he didn't remove the tariffs on Chinese goods and services. He was much more conciliatory in talking about it. And in fact, when President Xi welcomed Biden into the community of world leaders, he didn't lift the retaliatory tariffs either. So we are very much, I think, in a place that diplomats would find to be very positive. And you don't hear people talking in these terms very much, but we're at a time in history where the United States has a strong interest in American economic success. America, of course, is an important market for Chinese goods and increasingly for Chinese services, and we'll talk about that in a few minutes. And of course, the United States has a strong interest in Chinese economic success, an integral link in global supply chains, and increasingly a market for American goods. And again, I know we'll talk about this in the questions, but I do want to just comment that I find that Washington, D.C. is very much out of step with the rest of America. And let me explain. China is by far the largest export market of American agricultural goods. American farmers want a constructive relationship with China so that they can continue to sell their products into the Chinese market. Hollywood, we know, is very interested in expanding its access to the Chinese market and hopefully getting American entertainment content available at levels that are near where they were 8 or 10 years ago, when American movies and music was ubiquitous in China. Silicon Valley is interested in the Chinese market. Wall Street, where I work, is interested in the Chinese market and the U.S.-China relationship. It's really only Washington where the problems lie. And I don't want to be dismissive of this. Hollywood and American farmers and Wall Street, we don't write the laws. The laws are written in Washington. So it's important that Washington, we think, be balanced and in fact be influenced by the greater American industry and the American people who have an interest in not just stability across the Pacific, but in fact a constructive relationship across the Pacific. So in the end, when I am forced to bottom line this, I believe that regardless of a Trump or Biden victory in November, we are going to see a continuation of current policies and thankfully a continuation of the current trajectory with regard to U.S.-China relations. And we can see from the agreements made in November on the margins of the APEC meeting and that the execution on both sides is not only in good faith, but there's a sense of urgency to strengthen that floor under the U.S.-China relationship. Let's talk a little bit about those trade numbers. I mentioned U.S. agriculture, where some of the biggest deals really in history have only recently been signed for U.S. soybeans export to China, for example. Despite all of the tension and the rapids, as I mentioned, that have been navigated across the Pacific, the trade numbers don't lie. With regard to the trade of goods, China is America's largest trading partner on most important measures. And I would suggest to you that is not going to change, not in the lifetimes of any of us. There's an interesting fact, or I suppose an inflection point in history. I don't have a slide on this, but if you'll indulge me, Ritesh, for the first time in history, in March of 2010, American exports to Asia, now this is Asia, not China, but China, of course, being by far the largest recipient of U.S. goods and services. For the first time in history, in March of 2010, U.S. exports to Asia exceeded U.S. exports to Europe. And despite all of the tension and rough waters across the Pacific, that hasn't changed. And again, it's not going to change in our lifetimes, if ever. And that's because the growth is here. And consumers in Asia, and especially consumers in China, are more powerful now than ever before. And they have a very, very strong interest in American goods and services because they favor American goods as of the highest quality and the highest safety. And as a result, American producers increasingly have an interest in Chinese economic success. Now, I mentioned goods and agricultural products. There's, of course, services and even technology. And I did want to spend a minute talking about one particular company that has made the headlines here for a few months, and that is TikTok. TikTok has penetrated American consumer markets like no Chinese product ever has before. Fully 150 million or 160 million Americans are regularly using the app. And I can tell you that my wife and my 3 adult children are counted in that group of 150 million. And I think if you tomorrow were to disconnect the TikTok app on their Apple phone, they would very much become political activists. And that probably goes for many, many tens of millions more. I'll venture to say, should the app be somehow disabled on American iPhones, that there could be a revolution of sorts in the United States. And American politicians know that. They're trying to find a solution where they believe they must address a security and data related issue, but they're finding that American consumers can protect themselves and American consumers to take the risks they want to take, and most importantly, American consumers and American businesses are benefiting from the availability of this very amazing TikTok platform. American businesses are advertising on TikTok. They're making money using it as a distribution channel. And I believe it will be very hard for U.S. politicians to stand in the way of that. And in fact, we see in the newspapers in the last week or so that even Donald Trump, who at one time was very hawkish and particular about TikTok, calling them out at rallies, pointing fingers and saying that he would remove the app from availability to Americans immediately, has done a complete reversal. He's done a 180-degree turn because he recognizes that although this is a Chinese product, American consumers love it. And I offer TikTok just as an example of a Chinese product that can penetrate American markets, that can help American businesses, especially small businesses, and then is so attractive and enjoyed by American consumers. I believe it's just the beginning. I think there will be more Chinese products that will go international that American consumers will find to be attractive, and maybe the next group of these products will be in the EV sector. China is leading the world in production of electric vehicles, and the Chinese electric vehicle supply chain and ecosystem, if you will, is world-class. And this is coming at a time when government policy in the United States strongly incentivizes the use of and proliferation of electric vehicles, charging stations, batteries, the vehicles themselves. And in fact, many Chinese factories have relocated to be closer to their consumers in the United States. They're right over the southern border of the United States in Mexico. This is in the news just this week, as you know. And in fact, Washington is no longer talking about no Chinese electric vehicles. They're saying we need policy so that the Chinese electric vehicles are manufactured in the United States. This is similar to what happened with the Japanese automakers in the 80s, the Korean automakers more recently, and we at KraneShares believe that the Chinese electric vehicle automakers are going to follow suit, and with that will come all of the supply chain and related affiliated businesses. And by the way, it'll employ American workers. It's going to take some time. The auto industry in America famously is quite ossified, and labor unions are quite powerful. But over time, we expect China's great expertise in electric vehicles to reach the US markets and, in fact, to succeed, maybe not quite as wildly or as quickly as TikTok has succeeded in the United States, but nonetheless, we expect that we're very bullish on Chinese EV becoming international and especially reaching the powerful American consumer. Let me talk a little bit about timing and how to think about the U.S.-China relationship at this point in time. Nothing happens quickly when we have economies of this size and when the stakes are so high. So, we at KraneShares have paid careful attention to valuations, and we think that there is a lag with regard to the valuations of Chinese companies, and this is especially so in the tech industry. I've got a slide here I want to jump to in the interest of time. Let's see. So as I mentioned, our flagship fund is KWEB. We have a 10-year track record with the largest China internet fund on Wall Street. As I mentioned, it's more than $5 billion under management, more than 200 million shares outstanding in KWEB. And KWEB is a basket of China's leading companies, and we believe the companies that comprise the KWEB basket are wildly undervalued. When we look at the very frothy valuations in the United States, we are now, for me, in our third bull market in one lifetime. I'm very grateful for that, I would add. But we think American valuations in the American tech sector are near the top of where they will be. And as a result, investors need to be looking elsewhere for headroom for growth. And this is something our Chief Investment Officer, Brendan Ahern, talks about often. And just to put all of this in context, the valuation of Amazon, one company, a powerful and important company, but nonetheless, one single company eclipses that of the entire tech industry, the entire tech sector in China. We're talking about companies like Alibaba, Baidu, Tencent, that have access to 1.3 billion people, many of whom are more advanced in their use of technology in accessing consumer goods and services than even the American consumers. On the fundamentals, these Chinese companies, and certainly the composition of the KWEB basket of companies, should be 2x, 3x, or even 5x of the valuation of Amazon. But because of consumer sentiment, because of investor caution about China, that we believe it was mostly driven by those few factors that have now been cleared out from China-related risk. Because of that, the lag has undervalued these China internet companies. And so we think the time is now for consumers to take a close look, especially at China internet, and we expect the movement to begin in the first quarter of 2024. 2025. We believe that China is very much on sale, and that KWEB would be the place to enter the China market. One must be very careful to consider that there are going to be winners and losers in the Chinese economy in the same way there are winners and losers in every large economy. But the numbers are clear that the China internet sector is poised to be a winner, and we can expect it to return to some of its highest levels from the early days of 2021. I know we've gone a little bit past our time, Ritesh, and I want to be respectful to those who are participating online. So it may make sense to finish up there and go to some questions and answers.
Absolutely. All right. Thanks, David.
Yeah.
That was really insightful. And again, I think it's just insane to see the kind of valuations at which the Chinese companies are currently trading at. And again, a lot of investors, especially in this part of the world, we are knee deep or neck deep in Chinese investments, and all of us do want that growth to kind of come back and all. But of course, it's been a hard journey so far. But just looking at the gap that you talked about, from an Amazon standpoint and the whole KWEB, certainly the impact that the Chinese economy has is severely underrepresented in the global markets. Now, in terms of the things that I would like to focus on, maybe I'll divide it into 3 or 4 different parts, right? So we'll start with US politics, right? I think you talked a lot about those. We will go a little bit more on the wider geopolitics per se, and then we will come to a little bit of trade war, a little bit of these new sectors like EV, semiconductors, etc. What's going on, and the services side of things, and the consumer side of things like TikTok, etc. that you mentioned as well. Again, great points about all of these and gives us a lot of foresight as to what's to come as we move forward. And then I think more importantly, what does it mean for investors?
Sure.
And what can we look forward to?
Sure.
So kicking that off, I think the first question, of course, is, if and when, if Trump comes back. Obviously, you talked about it from a perspective that he was very hawkish on China when he, started his first, presidency. And more recently, we see a change of sorts, right? You said he's taken a 180-degree turn, when he talked about TikTok, etc. and all. Do you see, if Trump does come back, will he continue some of his policies that he had pursued, where he put America first and meaning that we favor the more local? There has been some implications even from a supply chain standpoint on these fronts, etc. But on the other side, there is a lot of geopolitics, which also mean that there needs to be, more cooperation, collaboration, military fronts you talked about and all as well. And maybe there is a space for cooperation rather than competition. So I think on that note, would be great to hear a little more deeper thoughts from you on Trump coming back and the implications of it on the U.S.-China relationship.
Sure. Well, let's talk about the factors that might lead to a Trump return first. It's going to be a very intense campaign over the next 6 months. And yes, you're going to hear the rhetoric about America first and Taiwan and North Korea and the South China Sea, and you're going to hear talk about that. But one of the things that's very different this time than was 4 years ago is there are 2 other foreign policy issues that frankly are probably a higher priority in the campaign and a higher priority for the White House. War in Europe, war in Ukraine, and war in the Middle East. Both are probably in a higher position of priority than is China, which for those of us who are interested in the Chinese economy is good news. It's good news. It's not to say that the security and international relations issues related to China have evaporated. We still have 3 hotspots: Korea, as I mentioned, Taiwan, and the South China Sea. But I think, as I mentioned, with President Xi waking up every morning and saying, "Give me a stable day," I think we can expect, so long as we have a high level of communications, military to military communications, we can expect some sort of depressurizing, if you will, of the 3 hotspots between the United States and China. Now, where does that leave Trump? That leaves Trump in more of an economic war, if you will, and he will probably use the word war. But I suggest to investors, look at what he does, not what he says. And that's true of Biden as well. And despite all of the hot rhetoric from Trump and even from Biden, the truth is that the policies towards China have been pretty stable. The same policies that Trump put in place in his first year, now, whatever it is, 7 years ago, remain in place. We kept expecting some of the trade tariffs, for example, to roll off. It didn't happen, and that caused a problem in the American economy, but nonetheless, they weren't ratcheted up. So we expect, regardless of the outcome of the election, to really see the status quo. And if you like the trajectory of the Chinese economy, and we believe there are signs, very good signs, that the fundamentals are quite strong in the Chinese economy, we can expect that the U.S.-China relationship, the status quo in the U.S.-China relationship, to contribute to that trajectory continuing.
Absolutely. Looking a little bit more internally within China, obviously, China, 2 sessions. This was country's annual parliamentary meeting concluded in early March. Now, what will be interesting is what were the key messages that we should look out for and stood out for you as well, and how could this kind of impact the relationship between the 2 countries?
Yeah, well, first, what do we look for? We look for projected growth. So in the People's Congress meeting, the budget was released and the expectation of, again, more than 5% annual GDP growth for China. It's very good news. Look, the days of double-digit GDP growth in China, I don't want to say they're over, but they shouldn't be expected to continue forever. We're growing on a much larger base now, of course, and so 5% on China's economy today is greater than 10% on Chinese economy 15 or 20 years ago. And it's those 800 million people who have found themselves or fought their way into the middle class that have made that happen. So I think the first and most important number is what's the annual GDP growth. The second number that's pretty interesting is the stimulus numbers. This is from the first meeting. China, and under President Xi's leadership, will undoubtedly continue to put public money into the economy for purposes of increasing consumer confidence and trying to deal with some of the sentiment that we think is a little bit of a hangover from the COVID lockdowns in China and is undoubtedly related to the real estate challenges in China as well. So we can expect easy money, we can expect government stimulus spending, and those were the messages out of both of these meetings. High GDP growth, government stimulus, and easing on monetary policy.
Great. And I guess moving on to a little bit more on the more futuristic look on China and US from some of the key sectors. You talked about EV. Obviously, there is a lot of things from a technology standpoint when it comes to semiconductors, chips, etc., and all.
Sure.
And we've seen a lot of tussle between the two when it comes to these key technologies, and US obviously wanting to guard these from a standpoint that a lot of this can get leaked out and then can have negative implications from a security standpoint on the US economy as well. So what are your thoughts about this? More from a short-term standpoint, but for also maybe the longer term, right?
Yeah.
Because right now there is, curb in some of these technology sharings to China. Does that mean that China will, start developing them in-house and 5 years, 10 years down the line, there is no longer that dependency?
Well, you made the most important point, and that is sort of what could strict export controls ultimately lead to. Let's first talk about what export controls are really about. Export controls imposed by the United States are about limitation of the export of goods, I suppose, or services, but goods, usually technology, that can be used for military purposes. And the United States has determined that certain very high-end semiconductors do have military applications that are sufficient for purposes of imposing control on the export of those super high-end chips to China. There's a disagreement, of course. The Chinese disagree, and they believe that this same equipment has civilian uses and peacetime uses. But that'll be the fight, and maybe that's part of the strategic competition that is underway. And it's noteworthy that Taiwan or China, mainland China makes up fully 10% of the semiconductors that are exported from Taiwan. So Taiwan and the mainland are very much tied together, in part as a result of this semiconductor industry, and it sets up what some people refer to as the Silicon Shield that protects Taiwan. And what does all this mean? If the export controls remain in place, then China will be forced to develop its own semiconductor ecosystem so that it can manufacture the highest quality and the fastest semiconductor chips. That's already underway. President Xi, I think, has made it clear he does not want to be dependent on the West for anything, and certainly not for critical technologies such as semiconductors. So, there are unintended consequences to every policy. And the Pentagon, which drives export control policy, I think the Pentagon of the United States understands the risk associated with an extreme export control regime, which might drive China into developing its own very high quality semiconductor industry. Now, there are those, I'm not an engineer, there are those who say that what happens in Taiwan and these chips are really special, and it'll be very, very difficult for that to be replicated anywhere in the world, including in China. And that may very well be the case. And for that reason, you couldn't handicap on a timeline when China would reach the point where they would no longer need to import chips from elsewhere. But nonetheless, I think the industrial policies of China are already underway, driving towards independence with regard to manufacture and these foundries.
Got it. Now, I guess you talked about US exports to Asia and it's surpassing Europe, for the first time.
That was 2010.
2010, sorry.
Yes,
okay.
that was
Not
2010.
paying attention.
Yeah, no.
but yeah, I think it's an important development. Also, I guess in the more recent history, there is aspects of the Indo-Pacific policy that has been in play as well. And whilst I think China has been looked at a more skepticism standpoint, over the last, say, 6 months, 12 months, etc., at least what we have noticed is we can see a little bit of a pivot from China to the other countries in the Asia Pacific, like India, Japan.
Sure.
And whether it is the supply chains kind of different companies trying to see if there are ways to untag themselves, not completely, but in some regards from China, but also looking at countries like India and Japan are as the places through which they drive the Asia growth story for the longer term. What are your thoughts about that?
No, it's a really good point. Look, this idea of China plus one or China plus two has been around a long time. It's not anything new. There's always been an interest in international businesses, multinational companies, to protect themselves from dependency on any one place. And that's not just because of geopolitical risk. The pandemic showed us the importance of redundancy. Weather events oftentimes show global businesses the importance of redundancy. So that's always, generally been a policy. But the geopolitical risk, I think, has made the issue more acute. And so multinationals have, in fact, fully implemented China plus one and China plus two policies. India, was sort of a natural place for many multinationals to go to create redundancy in their supply chains, and I think that'll continue. Whether that takes a big bite out of the Chinese economy, I think not. The truth is, while India is very interesting, Japan is very interesting, each country has its own issues and challenges, and China is in some ways, and I'm always careful not to use this word too often, but in some ways, China is uniquely capable because of its scale of providing integral links in the supply chain, and there's nothing about China, at least in the near or medium term, that's going to change. So I think for the foreseeable future, global supply chains will still have some dependency on China, even if there are China plus one or China plus two efforts underway.
Incredible. So now moving on to the equity markets and the general financial markets between the US and China, obviously there has been a divergence in performance over the last few years. We talked about, the returns in Chinese markets obviously have been very, very volatile. And coming to this part of the world where investors generally have a much higher allocation to not just China, but Asia in general, compared to, say, a US investor who will be more home biased from that perspective. Now, for that audience, obviously, the bigger question is, what do they look forward to? What does all of this mean to them from an investment perspective and investment lens? When it comes to China and its growth prospects, what are the sectors and what are the industries which will drive the future growth of China, and how should investors look at them, and are there ways for them to take these opportunities?
Sure, it's a great question. I'm glad you asked, because as investors, especially investors in Asia, we kind of have a front row seat to what's going on in the region, and a front row seat with regard to the rise of China. But what do we do personally to participate in that, to realize returns from that? The great thing about China, of course, and this is very different from almost every other country around the world, is you get a 5-year plan. The government announces every 5 years, here's what we want to do. And we are now in the midst of, I guess, the second 5-year plan, in which President Xi and the Chinese Communist Party has emphasized consumerism. They want Chinese consumers to spend, to improve their quality of life, and as a result to contribute to some independence for the Chinese economy. So Chinese consumer products are going to be one driver of the growth of the Chinese economy, and that's as a result of the power of Chinese consumers and very deliberate policies of the Chinese government. Another example is healthcare. China, very famously has an aging population. We know that Xi Jinping and leaders of China are going to be putting an emphasis on healthcare. So healthcare-related companies are going to benefit not just from demographics and the power of Chinese consumers, but also Chinese government policies. Electric vehicles, which we've talked about for a few minutes earlier today, clearly an emphasis on China, where China is poised to continue to be the world leader in the electric vehicle ecosystem. Again, a great opportunity where it'll be the power of the Chinese consumer as well as Chinese government policies that are going to power that growth in that sector. And of course, technology and internet. We've spent a lot of time talking about the internet companies in China. We expect this next decade to be a great one for Chinese internet companies, not just TikTok, but all Chinese service providers and Chinese technology companies. And then finally, clean tech. Again, we see this as very intentional by the Chinese government, supported by Chinese government policies, and of course the increasing power of the Chinese consumer around clean tech or green tech. There are products available, I know, through Syfe, KraneShares products that fit squarely in these thematics. We have designed them and produced these indices as a result of our study and our sources and our intelligence on what's going on inside of China. So consumers and investors should be looking to the combination of where does the power of the Chinese consumer and the deliberate intentions of the Chinese government policy come together. Clean tech, healthcare, internet, electric vehicles in particular, all fit squarely within that category.
Absolutely, and I think again you mentioned the point already that our partnership really wants to kind of capture that new economy sectors of China that will drive its future potential. It is moving, as you said, from a more manufacturing sort of dominant economy to a more consumer-oriented economy, and in the next 5 to 10 years, these sectors, the new economy sectors, are going to be the driving force for the new China that we'll see in the years to come.
That's right. It's not just an export economy anymore. If I were to put 3 lines on a chart that showed agriculture, services, and manufacturing, agriculture, of course, would remain pretty flat. And in relative terms, in relative GDP terms, manufacturing would flatten out, and it's the services that really hockey stick.
Awesome. With that, I'd like to conclude today's session with a note of thanks to Mr. David Adelman. Thanks for gracing this session today and providing your thoughtful insights on the complex US-China relationship and its implications for investors. Thank you everyone for joining us today, and we look forward to hosting the next session soon. Yeah, I think we are done.
Awesome.
Thank you so much.
Thank you. This was good. I appreciate it. I know I kind of ramble a little bit.
No, I think it was perfect.